All right, we started off a week today again with a very similar pattern we've been seeing over the last so many Mondays, where we kind of have some selling early in the day, and then we set our low point early, and then it actually ends up being the low point for the rest of the week. So is that going to be the case this go around? So I'm going to break down kind of what I expect to see in the next couple of days, and then what I expect to see going forward from there. So whether or not we are starting more of a decline or not, what's driving today's selling and why. Why were we negative? And does that have anything? Does that tell us anything about our intermediate trend that we're currently on, the intermediate run that we're currently on? Does that tell us anything about the near-term run that we're currently on? And what should we expect to see going forward? Does that alter any long-term expectations because of which sectors we expect to outperform the rest of the year? How has the dollar been impacting things? The dollar's been making some very strong moves. So we'll talk about that, and then we'll take a look at our trade idea in the stock that's been in its own bearish trend, and how can we trade that even with the bullishness we see in the rest of the market as well as its own sector. So let's go ahead and get started. Today is Monday, January the 11th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see today's downward move in the context of last week's rally. So very, very small. In fact, it stayed inside the range of Friday's lower shadow there. We're getting that little bit of a long lower shadow. Remember, lower shadows are bearish when you're at the top of bullish moves, or at least when you've been in a bullish move, because we don't know if this is the top. When you've been in a bullish move for a while, we have been in this bullish intermediate run since early November, so we're going on over 2 months now. So it's been a good while here. They're bearish, but they're not as bearish as long upper shadows are, like that one was, that we closed above the next day and pretty much nullified. So it's a bearish candle, not as bearish as it could be. And we filled in some of that range, and that's pretty much all we did, at least on the S&P 500. It brought us down. We still have a very strong bullish posture. We came really, really close to a cluster the last couple of days of the week. We got the near-term line dropping. We got the momentum line dropping to the reversal zone, but not to extreme lows. As always, that sets us up for a bullish intermediate confirmation signal, considering that this near-term run is just barely a few days old. We're talking 1, 2, 3, 4 days. So that could signal another little run, a little positive run on the current near-term rally that we're on. If you take a look, whoops. Let's go to the Russell 2000. You can see it wasn't as it was a little bit more bearish on Friday, just a little bit more, and wasn't as bearish today. So we actually almost finished with a positive gain. You can see the intermediate posture, long-term market sentiment strongly bullish. It had its bullish intermediate confirmation signal yesterday, and then it bounced back out of it today. So not really much of a move. Again, staying in the range of this last couple of days, very similar to the S&P. And then the NASDAQ, excuse me, let's go look at the NASDAQ. This was the most bearish candle. You can see we actually closed below the low of that lower shadow. So that's a little concerning from a NASDAQ perspective. Its momentum line dropped, but it dropped down to far lower levels. It got down below the 5th percentile. Lowest point during this whole bullish move that we've been on since this early period, and this early bounce, and then some volatility here. So a little bit of more of a bearish pattern. Still, the near-term line is not as down. It's not down very far, so it's not as bearish, but still, that's a little bit of a just a little red flag, just on the NASDAQ though, because you notice again the S&P even, which is actually a little bit more linked to the NASDAQ than the Russell. Which is usually the Russell and the NASDAQ composite are a little bit more linked to each other, because the NASDAQ's got a lot of small cap in it. But because it's really gravitated towards the NASDAQ 100, then it's actually been more linked to the S&P 500 with its market cap weightings. But it's been on its own today. Today it was kind of just doing its own thing. And a lot of it, as you'll see here, in the communication services sector. So, relatively bearish setups. And again, from a market forecast standpoint, we're the week's not done yet, but we'll just kind of get a glimpse, an early start to the week after getting 2 consecutive overbought clusters on the S&P 500 last week. You can see this week starting off with a very, very small range so far, and you still have very strong bullish positions. And you can see this near-term run that we've been on pretty much since that November timeframe. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This would be week number 11 of the near-term line being up above. So last near-term rally didn't last as long. The one before that lasted about 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks. The one before that lasted about 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 weeks before we had that little pause. So needless to say, this near-term run that we're on right now is a little long. It's a little long in the tooth. We've been up for a while, and we'll see how this plays out into some of these other indicators here in just a minute. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. Also, you can hit the red subscribe button on YouTube down below the video if you're watching us there. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and you want us to do another video again tomorrow. It's a quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. But if you do and you want to let us know, then click that thumbs up icon. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. We've been going for almost 3 years now, and we have a lot of people who are renewing. And so if you are one of those original batch of our original members, you do have that discount for your renewal. So if you didn't get that email from me, make sure you let me know and I can get you the code that you can use to be able to get that discount. Sorry about that. Also follow me on Twitter for more content in between the videos from day to day. There's my handle right here at DavidSettle42, and then join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. So every day I do the Market Outlook. I also do a live video on YouTube where I review all the trades that we've been doing in these videos that I do. We talk about when we get out of them. We talk about how we continue to manage them. So make sure if that's something that interests you that you check that out there, as well as all of our trading rooms coming up. Brandon's DGI class is coming up tomorrow, one of our most popular classes we have here. My options trading class we have tomorrow afternoon, and then you can see more when you click on that link. You can see some of the premium resources that we have over here for all of our chart links for all of our premium subscribers. You get access here. Our plus subscribers get access to, in addition to our premium subscribers, both of these get access to our Market Outlook Lives and our trading rooms. Our premium subscribers get access to our 2 Q&A sessions in addition to the trading rooms, as well as all these different premium resources here, including, like I said, our chart links, which we just updated today. So make sure you check that out if you're one of our premium subscribers. Come over here, hit this heart. It opens up a new tab. Hit that like button right there. Hit this thumbs up. It opens up another new tab. Hit this like button as well. Again, the more you do that, the more of our followers will see our content because it has engagements. It benefits you because Twitter and Facebook will promote content to you from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching. All right, now let's take a look at the long-term chart here with the Hakinyashi candles. And you can see after getting an upper shadow and a lower shadow last week, we're back to a higher close. We don't have a higher high yet, but we do have a higher close and a lower shadow. So another bullish candle. So no transition necessarily yet, even though the PPO is pretty much as high as it's been. When you look at the PPO here, give me 1 second, sorry. When you look at the PPO here, you can see it is the highest it's been easily in the last 20 years. If I were to go back to the 90s to incorporate those late 90s where things were a little crazy, we are in the 91st percentile. So there was some times where we were more bullish, but since then, this is the most bullish. We're 8% up above. The 10 period moving average is 8% up above the 40 period moving average. That's a very, very significant level of strong momentum. And again, last time it was as strong. We didn't necessarily, I mean, we came down a few times after peaking in these areas. One was a drop to the 200-day, one was just a sideways action, and then the third was another drop in 98. But, again, this didn't lead to an oversold condition in the market at all. We were bullish for multiple years there. So let's take a look at the 3 green arrow chart, and you can see, we're back to having 3 green arrows. That the S&P is above its moving average up here. You can also see let me activate this and move this up here to the top. You can also see too that the MACD and stochastics are green. The volume is tapering off a little bit and was way down today from what it was the last couple of days. To show you what that looks like on a 2-line basis, you can see that this divergence potential playing out. And remember, the 23% level is very, very important because that's where the low is in between. And you break that, we'll be below the 30-day moving average significant enough that could be an intermediate pull, the beginnings of one. Anything between 0 and 23. So we could drop down to 367, 368, 367 and a half. We could drop down that far and still just be noise. And that's, a little bit more than $10 from where we're at right now. So don't get too wrapped up in sell-offs or anything like that. Until you break 367 and a half, it's just noise. You break that though, and you'll be below the 17 easily. You'll be below the 30 easily. Then now we'll start looking at support at that 38% Fibonacci initially, because that's where that little parabolic high is. And then of course all the way back down, this is the pre-COVID high point here. It'd be coming down into this 340 area. Through 345 would be another layer of support, but then down and towards this area will be where probably worst case scenario would be. You take a look here at the DMI for the SPY, and you can see the ADX is still very strong, though we are diverging. We get lower highs and higher lows on both these indicators, with this higher high that we got as well on the RSI. We're still not dropping. We're still easily in bullish territory, well above 60 even. We haven't dropped in the lower half of the chart yet, and especially haven't dropped below 40 yet. And we're not into the lower half of the CCI either. So we're not worried about any kind of change in trend necessarily yet. We are above both the green and the blue lines. The green's still above the blue, though this barely. Still well above the cloud. And we've got a strong trend. We're above 5, we're above 80. So we have a strong trend going right now. And it's not easy to break strong trends. So at some point in time we will. At some point in time it will. You can see it drops to 0. It drops to 0 there. It drops to 0 there. So at some point in time it will drop. And then we'll break that trend. But obviously we're not there yet. Nor do we have any inklings of that yet. Finally, let's look at the Bollinger Band width here, and you can see after getting above the upper bands here, what we don't see though is a break above the upper Keltner channel. We got barely above the upper Keltner channel on Friday, very good, and the Bollinger Band, very good close, but now back below both the upper band and the upper Keltner channel today, and then the bands are still inside of the Keltners. So we still don't quite have a breakout move yet, and it might be a little bit of a kind of a false breakout move there on SPY. But again, that's that 23% area here is right where of this intermediate run that we're on is right where the this point of control, this not point of control, but this volume node. So there will be some support at that 23% level if there is any kind of near-term weakness before it breaks and turns into intermediate weakness, whenever that occurs. All right, now let's take a look at how it did today on an intraday basis. You can see we gapped down and filled in a lot of the gap in the afternoon. We still got some gaps to fill in from last week that we haven't filled in, and you would consider all of these common gaps. At the worst, you would consider them exhaustion gaps, like some of these IWM, and we started to fill in that gap there, and we did fill in the morning gap on IWM. We still got that one to fill in from last Wednesday, and then QQQ, you can see same thing from last Thursday. You have a gap we still haven't filled in yet, and we still haven't filled in We didn't feel in very much of this morning's gap. Some, but not very much of this morning. So if you take a look at, again, the volume, we did get an inside day today. So the high was lower than Friday's high. The low was higher than Friday's low point. We ended up closing closer to the low point. Again, there is not much volume between here and 372. So it's very, very easy for us to fall. As fast as we rallied, it's very easy for us to drop and fill that volume in. So don't be surprised if in the next day or two we don't fill that in. And I don't think it'll be anything more than just a near-term pullback, right? And enough to bring the blue line down and maybe come down towards the 23, the 30-day moving average. Maybe get light pink shading, even though I doubt it because we're rising above 90. We might get a yellow line, but nothing more than that I don't see. It'll just be kind of filling in this gap. Very strong resistance down in that level. Very easy for us to bounce off of that. You can see again, I showed you earlier the volume was very low, 50 million shares trading. The range today was less than 3 points on this inside day. So that puts us here when you look at it from this perspective. You can see 3 points well below, or not well below, but below the average, below the 1% mark, even though the ATR is still above the 1% mark. So that's something to keep our eyes on. And then the volume, like I said, all this volume and let me give you some context so you can see it from a higher perspective. The ATR is low for the post-COVID period. It's not low prior to that. It's actually pretty high still prior to that. So as volatile as 18 and 19 were, with some of especially 18, the ATR now is as high as it was at its peaks in those 2018 periods where things kind of hit the fan a little bit. Even if on a percentage basis it's still down closer to 1% than it is 2 when it was up at those peaks, because we've moved up, right? We're at 3.78 now, and the volume, like I said, is down lower, well lower than where it was at these peaks. So volume is kind of telling us, and volatility is kind of telling us that we're not quite as volatile, even if the VIX itself, actually, when you look at it from a longer term perspective here, let me go out 5 years. When you look at it from a longer term perspective, again, we are still above 20, and that's where we were at the most volatile periods before coming back below 20 and eventually below 15. We're not sniffing 15 anytime soon, and we're still easily above 20 as we kind of flirt with getting back up above the 90% range today and getting back into neutral. So, if we do have, again, just 1 or 2 days of weakness here, look for it to just pop up towards this, 95%, maybe a little bit higher. But like I said, intermediate pullbacks don't begin until you get a jump to about 105%. Unless you have, like this, there's an atypical intermediate pullback where the worst of the volatility is at the end instead of the beginning. That's atypical, right? It's mostly you get your biggest burst of volatility early, and then you just end up grinding or staying down for most of the intermediate pullback period, with most of its drop occurring early. So watch for that, but I don't see that happening either by the end of the week. At worst, most up like we just saw up towards this 95%, maybe a little bit higher here in the next few days. All right, before I look at this next segment here of our video, just a quick technical summary of our technical outlook. Obviously we've been bullish. Obviously we've been very extremely bullish. Last week we had some very extremes in some of these indexes, especially on the Russell 2000. And we've had a little bit of softness today. And not surprising, right? And it wouldn't be surprising considering how fast we rallied last week that we don't have a little bit more softness over the next day or two. But then, we probably still have another near-term rally or two left before this intermediate pullback starts. We're so strongly bullish here. Again, it's very hard to break the very strong bullish trends that I showed you earlier. So I don't think we're going to break it here with this kind of move. It typically breaks with a pretty significant move, unlike today, which was an inside day and a little small percentage loss and nothing significant, right? That it's hard to break very strong trends. So yeah, can we get a little near-term pullback over the next day or two? Sure. but most likely that's it. And we'll continue and persist on this grinding, strong, bullish trend for like I said, another near-term run or two to the upside. So what do you think? Do you agree with that assessment? Do you disagree? Let me know in the comment section down below what you think, especially if you disagree. What charts or indicators you're looking at that would tell you why you're either a lot more bullish than I am, that we're not going to get any kind of softness at all, even in the near-term basis, or you're a lot more bearish than I am, where we are about to break this bullish move that we've been on. What are you seeing that suggests why you think that? And share that down in the comment section below. All right, now let's take a look at what's driving the action today. And so you notice, this is a 3-month chart that we default to, and you see how strong the position has been in small cap stocks over the past 3 months. Of course, if you go back further than that, this is going back to October the 12th. But if we went to September, was the 25th, I believe, and then we go to a day chart, then you can see this is the low point that we had. We gapped up on small caps and everything since then. So really we're up 44% since that low point. See, small caps started pretty strong before that October, the Halloween low, which is where the S&P started to do well. So emerging markets up, small cap stocks up, bonds have been down, and gold and bonds are making another leg lower here. So really from about, 1.5, if I go to now 1.5 here, and let's just go to today, and we'll go to this 1.5 period. From that period, and let's go actually to like a 20-minute chart here. So here's the strength that we're seeing, the decline that we see in bonds and a little bit in gold, some weakness in the dollar. But since then, the dollar has been rallying, and that's put pressure on gold, a lot of pressure on gold. And stocks risk has been on, and that's put pressure on bonds. So as risk off as we had today, it really wasn't a risk off day. The reality is, because you can see bonds and gold stayed down, here's what just today looks like. If you look at just today, you can see the dollar is actually very strong today, and again put pressure on bonds, gold, but it also put pressure on bonds. There was some rally in yields despite the weakness in equities. And the weakness in equities, you can see, again, it's been pushed towards the Qs. The Qs have been what's been really falling. You can see international stocks underperforming as well, both developed and emerging markets. And small cap stocks actually almost finished the day with a positive. In fact, they were positive briefly. They were the only equity class that was positive on the day. So small cap stocks relative to the Qs, and let's look at this relative strength chart again. If you look at QQQ relative to IWM, you can see it's still a relatively bearish pattern here. We're still right around 1.5. We haven't broken this 1.5 level, but you can see how we're easily below the 50-day and well below the 200-day moving average. The only hiccup we had in this relative strength was the week between Christmas and New Year, so don't put a lot of stock into that. But again, as bearish as that MACD looks, as bearish as the longer term, as the PPO looks for the 50 and 200-day moving averages, the histogram is not falling anymore. So keep that in mind. And the MACDs or the PPOs moving average, the 9-day moving average of that PPO is just barely going negative. So we'll see. I mean, we had a really sharp decline here. The decline has been slowing down over the last few weeks. It appears we might be trying to find some support in this area, probably right around the 38% retracement of this parabolic move that we started. And the big strong bullish leg we started in 19, and then the parabolic move that finished it in 20, with a little bit of a divergence there into mid 20, and then now dropping. So it looks like we are slowing down that decline right around Fibonacci support, right around the 1.5 level, and looking, and I believe we'll, by the end of the year, have a leg higher on this, back up towards 2 and above, to where we'll get a divergent high point, a new high here, That's obviously not going to be nearly as high on a PPO level or on a regular MACD. And then that will be our last leg higher. It might be by the beginning of 2022, but I think there's still a lot of room for Qs to outperform. But and when we do start an intermediate pullback, I fully expect that IWM will be the one that falls, because again, you go back to that September 24th. That September 24th low, and then so from the 25th on, small cap stocks have been the outgainer pretty much the entire time. So when we do get an intermediate pullback, and the intermediate run really started here, but when we do get an intermediate pullback, it will be, it's usually the things that go up the most will come down the most. And there's nothing wrong with that, but that's what will generally end up happening. So if I were to go just to, the October 31st low point, so starting on this current intermediate run that we're on for the S&P as a whole, so all the way through here, then you can see there's the low that we come off of. You're still at 35%, and the Qs and the S&P are only at 16. So you got double the return during this period. That's what's going to give back the most. And there's, again, that I don't think that's going to be a change in sentiment. I don't think that this has not been this kind of let's go ahead and pile into small caps now because that's the new leadership in the market. No, they're still very small, and the sectors are still very small. So our bigger sectors are still in this large cap area. They're just really struggling right now, and so they're lagging behind while we're still bullish. And once things turn around, the things that have been the most bullish will give back the most. And then once we start a new intermediate leg higher, you'll see the Qs probably most likely lead the next leg higher, as we saw prior to that. I mean, again, you go back, all the way here to even pre-COVID low points, back to around August of last year when we really started this run. So I guess it would be about October the 8th of last year. So when we really started that run there, large cap stocks have been the leader. This small cap outperformance has been a recent phenomenon, and you can see the catch up they're having to do just to catch up with the outperformance that the Qs had before that. And remember, we can go all the way back to even the beginning of 2019 to some of these. In fact, go back to the other low point that we had here in May, when we hit that low point in May. So it was actually, it looks like June the 3rd. So let me switch this to the next month. So coming off of that low point on the 4th, again, you can see we're 84% off of that the end of May of 19 intermediate low point. By the COVID highs, we had strong outperformance. That strong outperformance has continued all the way up until, at that October low point, you can see small caps were barely positive from that May intermediate low point. They were barely positive there. And then now you see the recent outperformance to where now IWM is outgaining SPY, but still has a lot of room to run. So when the intermediate decline, when we start to breathe out, it will be small caps because they've been the biggest winners lately. But when we turn back around and get going again, you see who the leadership is, and who the leadership will most likely continue to be at that point. And there's still some run. Look at gold and long-term bonds. I still have a lot of outperformance relative to some of these risk asset classes, especially commodities, which has a long ways to go to get back to the upside. And the dollars have been really declining. So I expect that there's going to be some strength in the dollar here going forward in the short term. While we have this kind of risk-off move, there's your strength in the dollar. That's a very bullish pattern, mind you. A light pink shading and yellow line. We have broken that 23% retracement level. This is actually the last few hours, so this is the last full day there. We have broken that 23%, so I believe we are on an intermediate decline on the euro that might end here at 120. Most likely will probably go all the way through to just below 119. If that ends up being the case, if we don't bounce back up, we might bounce back up a little bit, but if we don't bounce back up and really kind of get going back up towards the 0% level, then and we start our decline, that's going to be coincident with this intermediate pullback that we're expecting at some point. Now let's take a look at the sector rotation and how that's performed here today. And you'll see again where the weakness came today, right? So here, let's go to just the 11th, and we'll go to a 10-minute chart. Look at XLC. Again, that's Facebook, that's Twitter. There's your media, your social media type companies down the most. Consumer discretionary down the most, along with real estate, utilities, interest rate sensitive areas. Remember, interest rates stayed up today, so that put pressure on those sensitive areas. And then you can see XLK lagging. So even though you had strength in these small cap areas, industrials, materials, financials, energy, the same thing. So we always see, like, that's been the winners. That's the IWM, right? Those are the small sectors. They've been the winners, but because your big sectors were such laggers, it brought the whole S&P down 0.06. If you look at it instead at the Russell 2000, which is this gray line right here, it was actually somewhat positive. So it steers more towards these sectors, the Russell, than the S&P does, which steers more towards these three big sectors, XLK, XLC, XLY, because of the disparities in these sector rotations. You take a look at the 12 grid for these different sectors. Again, you can see the S&P 500, a little bit of a rollover, and you can see it all here. Look at discretionary, how bullish it was last week. Look at XLC kind of dipping, giving us that light pink shading yellow line. But these interest rate sensitive areas, utilities and real estate, they're on bearish trends. If rates continue to be so strongly bullish, then these areas will reflect some really strong weakness. So that means your safe havens are going to be more kind of staple and healthcare. Those are going to be kind of more your safe havens, even though healthcare last week also had a big rally. Materials and energy also having a big rally over the past week, along with financials and industrials kind of matching. So, I mean, look at that last week in these small cap areas. Very strong moves, very, very strong moves. We would not expect them to maintain that, and discretionary as well here, but discretionary closing below that low point of that high day, and some of these others as well. Communication services, again, a little bit of a red flag in those large cap areas. All right, so that brings us to our trade idea, and I wanted to take a look at a stock in that financial sector that's not performing like the rest, and that's S&P Global. S&P Global it's not benefiting from the rising in interest rates. In fact, it's been on a bearish trend pretty much since the beginning of October, and it's only had brief little upturns that have been selling opportunities. And it looks like we've just barely had one because we bounced back down here today and closed below a lot of lows here. It got dark pink shading and a red line again. In fact, if you look at it on a weekly chart here, you can see we got dark pink shading and a red line on a weekly chart as well. And that near-term line is rolling over. Now we're only one day in, but the near-term line is rolling over now from what would be a bearish high point here. So, it's kind of looking like, you have some opportunities to be bearish on S&P Global. You can see the three red arrows with two red arrows. The MACD histogram is rolling over. Here's the two-line version of that chart. We are dropping below the 17 and 8-day moving averages after being above it. The 8-day has crossed back below the 17. That's why the MACD itself is negative. The MACD is close to crossing below its moving average, which will give us that third red arrow. But you can see how we close below these lows. The stochastics closing below its moving average. You can see the CCI and the RSI also rolling down, coming down from what would be bearish high points and getting into the lower halves of both of their charts. You can see from a directional movement standpoint here that the negative index jumping back up towards 25, close to being back above it, actually was above it briefly here at the end of the day today when we made this trade, and then the positive index dropping was actually below 20 with a very low ADX. It still has room, so we've been kind of declining without an increase in the ADX, and we'll see if we get an increase with more of a directional move. You can see the Ichimoku cloud here we are below the cloud, and we are crossing back below. We had been above the blue line briefly here. We're back below the blue line. Now we need to see if the green line will move back below the blue line as well, as we maintain some bearishness below the cloud. So if you look at the Bollinger Bandwidth, however, there's not a whole lot of directional opportunity to the downside, because we do have a pretty strong node here at 300, and we are in the value area. So the point of control, though we are breaking below that too, which is negative, it's still going to act as a kind of a draw, a center of gravity. So we won't have a whole lot of downside movement, at least down to 300. So that sets me up for doing a short call spread on this. So if I were to take a look at SPG, I will sell the mid-30s delta, so sell the 330 by the 340. I like the fact that it's a $10 wide spread because it does give me the ability to manage my risk. $300 is typically what we're shooting for on a normal position, because that's 30% return on our normal risk, which is $1,000. So that's what I'm normally getting for $1,000 of risk, but because of the $10 wide spread, I'm actually getting it on $700 of risk. So with earnings coming up, it's nice to have less risk than normal, but still go for a decent gain. Now, I don't want to lose even $700, so I still want to keep my loss capped to 300 as much as I can, because that's what I'm trying to make. But that's how my setup is, and you can see that break even ends up being right above this high point that we had. So we gapped up here, and we've been on a decline ever since. So now we'd have to reverse this breakdown that we had today below all these lows of last week. We'd have to reverse that breakdown, get back up, and get back through the value area and back to the upside for us to get to where we'll close out with a $300 loss. As remember, the point of control is right where that midpoint is. So it's not going to be easy to do that. You'd have to reverse a breakout in order for that to happen. So we'll see how that plays out, but that's how we'll manage that trade going forward. So that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to your Market Outlook forums on our website at marketscholars.com. There's a message board with our community. You can open up any new thread with any questions or comments you have, reply to anybody else's, and let's keep this conversation going in the Market Outlook forum. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, on Twitter and Facebook as well, like those, and then comment on our video. Have a great rest of your Monday night, everybody, and we'll see you all next time.